The two prior bull markets saw gold go up eightfold above what had been the prior bear low. If gold simply matched those old bull markets and did the norm again, it would be 8,000 plus, just to match what it did twice before under conditions that are hardly comparable to what we've got now fundamentally. So people are looking at an arithmetic price chart of gold, say, oh my gosh, look at vertical, I got to take profits. Stand back.
The truth is that if you look historically, gold typically goes up ahead of geopolitical events and it drops after the event has started. That's a normal pattern unless the event comes completely out of a blue, like 9/11, for example. But the Russian invasion of Ukraine, to take a most recent example, gold moved up ahead of the invasion. And then in the 6 weeks after the invasion, it gave back all of those gains. And we saw that with Iran. That's a normal pattern. It's buy on the rumor, sell on the news is one.
Gold isn't a failed hedge, UBS strategists said in a report last week, because it doesn't always rise during geopolitical conflicts, particularly at the start of them. But investors need to remember that gold tends to perform best when growth expectations fall and central banks cut rates, leading to lower real yields usually during the second phase of the A crisis, they said. Gold prices should improve, in other words, when macro expectations worsen. MichaelOliver and AdrianDay are renowned precious metals experts and market analysts, offering in-depth insights into gold, silver, and global economic trends. Regarding the long-term drivers of gold, during the interview, MichaelOliver notes that monetary degradation is the key factor. According to him, gold's price movement reflects this loss of value rather than reacting directly to geopolitical crises or war news. He predicts that short-term events, like spikes in oil prices or conflicts, may influence market sentiment, but they are not the main reason gold trends upward. Concurrently, Oliver mentions that historical bull markets saw gold rise many times over from prior lows, suggesting that the current levels are still relatively modest. From a technical perspective, Oliver also points out that buying gold based on war news often leads to temporary losses. In his view, investors should focus on these broader economic trends rather than short-term market reactions. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from MichaelOliver and AdrianDay's recent interview.
But the main thing driving gold is we know historically, if you stand back and just look at a chart going back 50 years or more, monetary degradation, M2. Look at an M2 chart. Looks like a great place to be. Vertical market, okay? Parabolic even. It's lovely. Well, what it means is the buying power of that piece of paper diminishes and diminishes every decade by about, increase the supply about 80% every decade of the money supply. And so it causes problems. And, bubbles. Well, we have a stock market bubble. We do not have a gold bubble. Gold, for example, right now, per ounce, is only gained right now about 4 times, a little bit more than 4 times the price of the prior bear low in 2015 at $1,050. Okay. The two prior bull markets saw gold go up eightfold above what had been the prior bear low. If gold simply matched those old bull markets and did the norm again, it would be 8,000 plus, just to match what it did twice before under conditions that are hardly comparable to what we've got now fundamentally. So people are looking at an arithmetic price chart of gold, say, oh my gosh, look at vertical, I got to take profits. Stand back. Now, silver's been depressed for 50 years, below $50, while gold kept making new highs. Silver would go up with it, but it couldn't get past that range. Now it says, oh, I'm alive, okay? It's the central banks destroying money. Look at an M2 chart. As we said, it's parabolic. It looks lovely. Okay, well, that money flow goes somewhere. Well, for 16 years, it went into the stock market, 17 years now, and it bloated the stock market into the biggest bubble it's ever been. When that bubble breaks, the money goes somewhere. And if you go back historically, whether it's recession, depression, or not, 29 to 32, 73 to 74 in the S&P with a crash at the end, by the way, in 74. Gold was exploding at the same time. 2000, 2002, stock market got cut badly. NASDAQ went down 82%. During that time, gold was rising. 2007 to 9, with the exception of that one bad month in October, gold was rising during that bear trend in the stock market. It's the central banks acting to protect that which they want to protect. And their mandates are seemingly conflicting. One, they have inflation, which they define wrongly. What they define as inflation is the effects of inflation. In other words, rising prices. They're not concerned about printing stock prices higher. That's okay. But when they print the price of corn or oil and it goes up, then that's called inflation. Not when it goes into the stock market. That's okay. Okay. Anyway, right now you've got Powell, what? He's got a month left or something before it's mid-April or something. Okay. Does he want to go out with a dark legacy? Or, where Trump could say, you caused this recession. You didn't cut rates like I said. All Powell needs is some excuse. And the other day when he was speaking, it was subtle but important. He said, the rise in oil is probably temporary. In other words, we can dismiss it. And inflation's sort of under control. We certainly, they expressed no fear about the inflation issue, meaning he's setting the stage for rate cuts. Because if he goes out of office and at the same time he leaves office, we start to have stories about a big bank. By the way, we analyze the banks closely, and there's something going on there. You go back historically, wars do not cause gold to go up. Yes, wars cause governments to spend money, hence they print more money to justify, et cetera. But that correlation is very loose, and the notion that that's what causes gold to go up is wrong. What causes gold to rise, ongoing, in waves, no doubt, is the monetary degradation. It is money. Therefore, if you destroy the real buying power of the dollar by printing more, 80% every quarter, every 10 years, it increases in supply. Therefore, its buying power diminishes. And it's not gold going up, it's the value of the money going down. And gold is reflecting that, or versus the yen or versus the euro. That's what drives gold. And the notion, when you get people that buy war news, they usually get slammed for it. That's not the reason that gold and silver rise. They rise for the other reasons and the ongoing reasons. War simply, it might, we'll go back and look at the Ukraine thing.
During the interview, AdrianDay explains that the usual expectation of gold rising in response to wars can be misleading. Historically, gold tends to move up in anticipation of geopolitical events and then often retraces once the event is underway. Using examples like the Russian invasion of Ukraine and recent tensions in Iran, Adrian predicts that the early gains in gold are largely driven by speculation and buy on the rumor, sell on the news behavior, rather than the actual outbreak of conflict. The recent sell-off in gold was driven by knock-on effects of the war, market experts say. The shock to global energy supplies boosted expectations that prices of goods and services will go higher, and for that inflation to push the Federal Reserve to pivot and hike interest rates, which would make gold less attractive. Concurrently, Adrian highlights the role of liquidity during crises. He explains that global or regional events often trigger a rush for cash, forcing people and even governments to sell gold holdings, as seen with significant sales in Dubai and Turkey. He mentions that these forced liquidations can temporarily push gold prices down, even amid heightened geopolitical risk. Let's jump into the interview.
I just read yesterday, in fact, by a very, I won't name him, but a well-respected, well-informed commentator saying, I'm getting lots of questions on why gold hasn't gone up in response to the war, and people are puzzled. I am too. But the truth is that if you look historically, gold typically goes up ahead of geopolitical events and it drops after the event has started. That's a normal pattern unless the event comes completely out of the blue, like 9/11, for example. But the Russian invasion of Ukraine, to take a most recent example, gold moved up ahead of the invasion. And then in the 6 weeks after the invasion, it gave back all of those gains. And we saw that with Iran. That's a normal pattern. It's buy on the rumor, sell on the news. No, if you look at take Russian invasion of Ukraine.
Yeah.
I mean, for 6 weeks, the tanks and the troops were massing on the border of Ukraine. Mm-hmm. And there was debate in papers and, Substack and everything. Are they going to invade or aren't they going to invade? It wasn't clear they were. I myself thought they wouldn't. But I mean, the signs that they might were there as the tanks were on the border. And this time, I mean, we can hardly say the bombing was a surprise. It was a surprise that it took place in daylight, but it wasn't a surprise that it happened. So I think gold just moves up ahead on all of the speculation. So it's buy the rumor, sell the news. But the other thing that's very important, there's two other important aspects to this, David. One is liquidity. Anytime you have a geopolitical event, you typically get some kind of liquidity crisis, whether it's global or regional. And in this case, you've certainly had a liquidity crisis in the Middle East. You look at Dubai, people wanting to leave Dubai, families, expats, maybe the expat stays, but he sends his family away and they've got gold stored. So gold was selling at a discount in Dubai as people just rush to sell everything to move out. That's a typical sort of example. We are obviously a typical sort of case. And we obviously had Turkey sell. We know that now, nearly 60 tons, which is massive, by the way. To put it into perspective, that's 60 tons they sold in 2 weeks compared with what total central bank buying of 850, 860 last year. So to sell 60 in 2 weeks is very, very meaningful. And that's all part of the war because the war hurt the lira. So they sold their gold to defend the lira. And the third factor, I don't know if I explained that properly. The third factor, which is very significant, is there are considered two major safe haven assets. One is gold, and one, of course, is the dollar. And if you look at the dollar and gold since the beginning of February, you see it's almost, as you put it with the bonds, it's almost an inverse relationship. When the war seemed as though it was going well, the dollar started falling and gold started moving up. And when the converse happened, the dollar was moving up and gold was falling. So, yeah, I don't see it as a great anomaly, frankly. I mean, we did also exit producers and explorers who were in that region, including East Africa, which is very close. But no, broadly speaking, their output is not affected. Of course, their costs will go up. And again, there's some sort of exaggeration there. I think you look at the cost of oil, which is the major input for gold mining companies. It's their number one cost input. But BMO, Bank of Montreal, did a study where they said that for every $10 increase in the price of oil, it adds $2 to a gold mining company's costs. So $40, that's about 9%, because it compounds, obviously. So 9% cost increase is meaningful. But when you're at Ego and your all-in sustaining cost last year was 1347, was it? Or 1327? 13. Let's just be conservative because I forget the exact number and say less than 1350. And you're selling your product at 4,500, a 9% increase in costs is not devastating, right? It's not devastating. So I think we don't realize just how fortunate we've been for the last few years. While the price of gold has been moving up, costs have really stayed pretty stable. And the margins have expanded in an unprecedented level. Unprecedented. Because normally, when the gold price moves up, the input costs move up. The cost of oil goes up, but commodity currencies, which is your second largest cost input, because that's everything local. you're a Canadian miner with a mine in Australia, the Australian dollar affects what you have to pay your workers, what you have to pay for food, what you have to pay to build camps, etc. And so think back to 2011, gold was at 144, the Canadian dollar, the Australian dollar were trading at 25-30% premiums to the dollar. This has been a completely different environment. And so a 9% increase in costs, even if gold goes to even if oil goes to $200, what are we talking? We're talking about 25% increase in costs.
The future trajectory of the gold price depends on how long the conflict lasts, and broadly what happens to the global economy as a result. If the oil price remains elevated, it could materially impact global inflation. Normally, that would be beneficial for gold prices, though if this coincides with further strength in the dollar, then that impact could be mitigated. In light of the impact of the war in Iran, can gold prices rally further this year, or are more falls in store? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.